Holy flippity flip flop flap and smokes, everyone. There is nowhere to run or hide. We're seeing all major asset classes crashing and crashing high right now. From stocks to bonds, cryptocurrencies, even gold and silver, commodities that are meant to be an inflation hedge are not holding up in this everything bubble that is collapsing. And we've just got some huge news and huge developments out today that gives us a forecast of what pain is going to be coming ahead. And people, this was a very dire forecast we were given from the Federal Reserve about what's going to happen to interest rates, how the economy is going to be facing a painful recession, how the housing market is going to be facing a painful correction, and how there's not going to be any help or any aid come anytime soon. We've also got some new warnings from economists and billionaire investors that tell us how bad this crash will get. And we have some shocking data that is signaling something in the financial markets is about to break. And I'll go over at the end of this video what we need to do right now to protect ourselves. So everyone, this is going to be an action-packed episode. Let's not waste any time. Let's get straight into the news, the facts, and the data. Well, look at this, everyone. Markets ruled by inflation leave investors with nowhere to hide. And that's absolutely true. Look at this. The S&P 500 is back in bear market territory, down 20.99% year to date. And this is what I was trying to warn many people about. We recently had a rally in July and August, but I was trying to warn people this is just a typical bear market rally, with the average rally being about 17%, which is exactly what we had. We're going to see more rallies like this during the bear market. During the most painful and the most steepest bear market declines or stock market crashes, that's also when you're going to see the most violent rallies. But people, if the fundamentals don't change, if the data doesn't change, don't buy into this FOMO. It is a trap from Wall Street trying to squeeze out every last penny you have. And look at this, even traditional safe haven assets like bonds. This iShares 20 plus year Treasury bond ETF is down 28% over the past year. That is absolutely unheard of, people. This is the worst bond market crash we've seen in decades, and the bond market is much bigger than the stock market. And many retirees, they have a lot of their savings or their nest egg in bonds, and unfortunately we're seeing their 401ks, their superannuation, their retirement funds being completely wiped out. And this is going to force a painful recession because the baby boomers are the wealthiest generation. All that money that the millennials will set to inherit, well, it might be gone by the time it comes due. Look at this, Bitcoin down 61% year to date. So it looks like Bitcoin is not a very good store of value. Remember all the people said it's going to 100,000, 250,000, 500,000, a million? Well, people, while it may eventually go to that price if we hit hyperinflation, it isn't going there anytime soon. And even traditional safe haven assets like gold are down with GLD, the ETF. Yes, I'm just looking at the paper version. You'll want to get real gold, but even this ETF, which is meant to be a safe haven asset and an inflation hedge, is down 13%. And so you may be thinking, well, okay, markets have already crashed. Surely the worst is over. Well, people, unfortunately, I've got some bad news for you. No, the pain has only just begun. We've got a huge announcement from the Federal Reserve today to say about what they're going to be doing with interest rates, the economy, and the housing market. Listen to this. Stock market bulls reluctantly fold on Fed's grim economic message. The S&P 500 plunged 1.7% in the worst Fed day showing since January 2021. So what we've been seeing is stock market bulls remain optimistic that the Federal Reserve is all of a sudden going to U-turn, or they're going to stop lifting interest rates, and they even thought that the Federal Reserve will start cutting interest rates in 2023, while they've all been dealt a reality check today. It took longer than it should, but the stock market traders finally heeded the Federal Reserve's latest message: the inflation battle will cause real economic pain. Remember when they said, don't worry, inflation is transitory? And then they said, don't worry, interest rates will only go up a little bit. Then they said, there'll just be a soft landing. Well, no, people, we're going for a hard crash landing. After rising as much as 1.3% when the Federal Reserve delivered its third straight 75 basis point hike, the S&P 500 plunged into the close as Jerome Powell made it crystal clear that the central bank is going to keep raising rates sharply until officials see signs that price pressures are easing easing, and that's a process that won't be painless for the labor market and the housing market, the Fed chief warned. So they've just given us a new forecast on how high they think interest rates are going to have to go in 2023. And people, they've continually been wrong on how high interest rates are going to have to go. So even these new updated projections, I think they're going to have to go much higher than this. But let's have a look what they're saying. Policymakers unveiled fresh predictions that rates would reach 4.4% by the end of this year and 4.6% in 2023. A more hawkish shift in the so-called dot plot than anticipated. Beyond that, rates were seen stepping down to 3.9% in 2024 and 2.9% in 2025. So this is what's spooking the market so much right now, people. The Federal Reserve is saying interest rates are still going to remain around 4% into 2023 and 2024. There's not going to be any pivot and there's not going to be any rate cuts coming. And what this means is there's going to be more pain for the economy. This recession we're in now, if they have to go above 5%, I think we could be facing not a recession, but a depression. And guess what their GDP growth forecast was for 2022? That's right, just 0.2%. They expect the economy to grow just 0.2%. And what I really think will happen is it'll go negative, or the real data should be negative, or they may find a way to manipulate it. But when you factor in that inflation is 8%, in real terms, we're having negative GDP growth of at least 5%. So this means all 2022, we will be in real terms a recession. And like I said, it could be about to get much, much worse. Right now, there is absolutely no place to hide. From stocks to bonds, gold, silver, cryptocurrency, everything is getting crushed. Just look at last week, 99% of companies lost value. And I'm sure we've all had the same thought. Wait, I'm well diversified, but why is my portfolio still getting hammered? Well, it may be because we're not diversified in the right way. We haven't had this inflation crisis since the 1980s, so we need to hunt down a solution for our time in 2022, learn from history to see how we can hedge from this inflation crisis and from this broad-based market sell-off, because I don't think this is a buy the dip opportunity. I think, and many of you think, it is going to get worse. And Goldman Sachs just released a shocking report last week that says the traditional 60% stocks, 40% bonds portfolio is no longer working. And look at this chart here, everyone. The 60/40 portfolio has fallen 20% just this year. And we all know day trading is very risky and doesn't work for the majority. Value investing isn't working right now because even value stocks are getting hammered. And Bloomberg has just released this report, markets roared by inflation leave investors with nowhere to hide. As a result, Goldman Sachs says the ideal stock allocation has shrunk from 60% to 45%. What do they recommend to do with the difference to salvage your returns? Well, they're saying it's time to invest in real assets. And one of those real assets is contemporary art. Look at this chart here. Real assets have outperformed a 60/40 portfolio in periods of high inflation. The last time inflation was this high, it appreciated more than real estate and gold with an outperforming return of 33% on average. And I've been telling people this for months, and that's why I've partnered with Masterworks. Just look at the results so far. 6 exits with an average return of 29% so far, outperforming the S&P 500 and cryptocurrencies. Some of my subscribers that signed up already exited a month ago with a return of 33.1%. As a result, Masterwork has had to acquire more art to keep up with the demand, and there is a wait list. But for my subscribers, you can skip the wait list, click the link in the description, also leave a pinned comment, and you can sign up with Masterworks today. Now, back to the content. Jerome Powell also came out and said that the housing market is still overvalued and house prices are still too unaffordable, and that the housing market needs a correction. And he says this correction, his words here, is going to be painful. And if mortgage rates go above 7%, that means people's purchasing power compared to 2020 when they could get a mortgage of 2.75%, they're going to lose about 40% of their purchasing power. And the housing market relies on debt, it relies on people having a job. We're seeing more and more layoffs announced every single week. So what we could see over the next 2 years, if interest rates don't go lower and they keep going higher, we could see at least a 20 to 30% correction in the housing market. What are we seeing right now? We're seeing the S&P 500 is in a bear market. We're seeing cryptocurrencies crash, and the housing market is very slow to react, but we will see the housing market crash. And unlike 2008, the Federal Reserve won't be able to save the markets this time. And unfortunately, a lot of investors are still delusional, but they will start to wake up very, very soon as the Federal Reserve keeps on reiterating, no, we're not going to be there to save the day. And what's even more worrying is Now the Federal Reserve is selling bonds and mortgage-backed securities on their balance sheet, which means bond prices are going to keep crashing, which means people's retirement funds are going to keep crashing, and it means interest rates are going to keep going higher and higher and higher. And this could lead to something in the financial markets breaking, like what we saw in 2018 and 2019 with the repo market crisis, when overnight interest rates spiked to 10%. But you know who this is really going to affect the most? That's right, the US government. With nearly $31 trillion in debt, with every 1% increase in interest rates, that's going to be another $300 billion in interest costs. Look at this, Fed rate hikes will add trillions to national debt. Every increase in interest rate rises the federal government's interest expenses. So far, in the fiscal 2022, the US Treasury has forked out $471 billion just to fund the government's interest payments. According to the Congressional Budget Office, this is exactly what will happen. It projects interest payments will triple from nearly $400 billion in fiscal 2022 to $1.2 trillion in 2032. And it's worse than that. The CBO made this estimate in May. Interest rates are already higher than those used in its analysis. So I don't think people understand how bad this is, because what we're seeing right now, or what we saw in 2020, was not only the central bank there to save the day, but the government was there to save the day with trillions and trillions of dollars worth of stimulus. But as interest rates keep going up, when the Federal Reserve hikes interest rates and when they sell bonds, there's not going to be anywhere to buy the government's debt. Nobody is going to want to touch it. And this means the federal government could risk defaulting on its debt if investors no longer want to buy the debt because they think the bond prices are going to fall. The Federal Reserve is no longer going to be the buyer of last resort. And so what you're probably wondering, okay, well, how much could stocks fall and how bad could it really get? There is an economist here that is giving a dire warning. Dr. Doom Rubini expects a long, ugly recession and stocks sinking 40%. Dr. Doom cites high debt ratios of both firms and nations, and global recession throughout 2023 will hit zombie countries. And I think with the Federal Reserve lifting interest rates to 5%, he's right on the money there. We're already down 20%, so it is not too far-fetched to think that stocks could fall another 20 to 30% with interest rates rising. And remember, we haven't even started to feel the pain of these interest rate hikes because they've risen so rapidly. We are still going to have to wait to get the data, which always lags, to see how bad things are really going to get. Rubini, who's precise on the housing bubble crash of 2007 to 2008, earned him the nickname Dr. Doom. That said, those expecting a shallow US recession should be looking at the large debt ratios of corporations and governments. As rates rise and debt servicing costs increase, many zombie institutions, zombie households, corporates, banks, shadow banks, and zombie countries are going to die, he said. So we'll see who's swimming naked. Now, unfortunately, he's right here, people. We've seen a record amount of zombie corporations. We've seen so many companies that should have gone bankrupt in 2008, and in 2020, they didn't go bankrupt. They've just been offered this cheap 0% interest rate debt to keep on going along, even though they're losing money year after year. Kind of like Sears, for example, they haven't turned a profit since 2011. But now, with no more stimulus, with no more cheap debt, these zombie companies are going to die. And like Warren Buffett says, everyone's a genius in a bull market, but it's only when the tide goes out you see who's been swimming naked. As a result, Rubini sees a stagflation like in the 1970s and a massive debt distress as in the global financial crisis. And what I think is going to happen is we're going to see a foreign debt crisis, because what are we seeing right now? The dollar is absolutely surging in value. That's making other countries' currency weaker and weaker and weaker. And a lot of them have debt in US dollars. So as their currencies fall, as the dollar rises, they're already in trouble. But that means they're going to have to use more and more of their currency to repay the debt. We're already seeing a lot of countries facing high inflation. They're going to have to print more money to repay the debt. And it's going to cause a lot of these countries, like we're seeing with Iran, Venezuela, Argentina, Turkey, Sri Lanka, Pakistan, etc., going to collapse. And for those worrying it's going to be a short recession, no, it's not going to be short and shallow recession. It's going to be severe, long, and ugly, he said. Rubini expects the US and global recession to last all of 2023, depending on how severe the supply shocks and financial distress will be. During the 2008 crisis, household and banks took the hardest hit. This time around, he said, corporations and shadow banks such as hedge funds, private equity, and credit funds are going to implode. This is what I'm really worried about, everyone. We saw what happened when Lehman Brothers collapsed. I think it's only a matter of time. I think in 2023, we're going to see a major financial institution collapse, like what we're seeing in China with Evergrande, that's going to have domino effects and contagion across the whole financial markets and could make this crash into a full-on financial crisis. Because there's something very disturbing happening in the bond market. Look at this. This is the spread between the 2-year and the 10-year treasury yield. And when this inverts, this is predicted every single recession. Now, it inverted in April this year, but it also inverted again on July 7th, and it's been inverted ever since. And it's now got the steepest inversion of 0.051%. And there's also a couple other worrying trends. We're seeing demographics change. We're seeing an aging population, which is very bad for the economy, as there's more people retiring, more people draining their pensions, and there's less workers and less taxpayers, which is less revenue for the government and more of a burden on the working class. We're also seeing a transition away from globalization. Globalization has made inflation very, very low for the past 20 or 30 years. It's mean that central banks and governments could print heaps and heaps of money and not have to worry about inflation because they could offshore their production to keep costs lower and lower. Unfortunately, with things happening with China, there's not going to be much cheap labor anymore. A lot of these third world countries are demanding more and more compensation for their labor. They've really hit peak globalization, and that means we're going to be facing decades of high inflation. It's not going to go away in 2023, people, or 2024. We're going to have this inflation around for a while. Now, how you're going to want to protect yourself, not financial advice, but just what I'm doing. You want to diversify. You don't want to be all in on one asset class, especially stocks and cryptocurrencies right now, and real estate. And with food prices going up at the fastest pace since 1979, I'll think about, if you haven't already, start food storage, start buying essential items, because prices are only going to get higher and higher and higher. And do whatever you can now to start a side hustle, second job, to start building savings, cash on the sidelines, so when these markets really do crash, you will be in a strong position to not only survive but to thrive and to buy all these luxury homes, cars, stocks, assets on a discount. But everyone, this is just some of my thoughts and opinions. What do you all think? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.